This chapter 3 discusses hybrid securities and explores the important role they are expected to play in the capitalization of banks going forward. Hybrids generally can be described as instruments that have mixed characteristics of both debt and equity, and which often represented the cheapest form of capital for financial institutions on account of the deductibility of their interest payments for tax purposes. Hybrids typically carried all or most of the following features. They entail so-called loss absorption either as a going concern or as a gone concern, meaning that they are deeply subordinated to other debt of the issuer in a liquidation scenario, and senior only to common stock and some preferred, and can be written down under specified scenarios. They have some ability to defer distributions without triggering a default. Sometimes deferral could be cumulative and other times non-cumulative. They are long-dated or have a perpetual maturity. They are callable after a specified number of years and are frequently subject to a coupon step-up, if not called. And they are included in regulatory capital under Basel rules but subject to various limitations. A very important feature in hybrids is the call option referred to above. The purpose of this call option was to permit the issuer to refinance if and when attractive opportunities came along, and to provide the investor with some assurance that the instrument will be retired in some reasonable time frame. A step-up or increase in the instrument's coupon after the first call date was common, to increase the issuer's incentive to redeem. Some limitations were imposed on the extent of this step-up by regulators and rating agencies, but even a mild step-up was invariably sufficient since refinancing would be cheaper than paying the higher coupon after the step-up. The issuers also worried about the reputational consequences of not calling the instrument even if they were legally permitted to do so. Deutsche Bank became the first major exception during the credit crisis to enforce this privilege, meaning to refuse to call an instrument and accept instead the higher coupon following the step-up. Despite this, regulators remain unconvinced of the extent of the instrument's loss absorption and flexibility characteristics. Whether a hybrid is classified as a debt or equity is a question that arises from a number of perspectives and that requires consideration of different rules and guidelines. The most important of these are, with regard to the balance sheet treatment, whether the instrument is to appear as debt or equity on the balance sheet, which also affects debt covenant ratios for most issuers. With regard to the income statement, whether distributions under the instrument are treated as dividends or as interest, which again affects debt covenants in addition to financial statements. From the tax perspective, whether distributions under the instrument are tax deductible for the issuer. Again, from the tax perspective, whether distributions received by the investor may benefit from tax exemptions applicable to dividend receipts. From the perspective of the credit rating agencies, whether the instrument generates so-called equity credit from the ratings perspective, and if so, to what extent. Again, from the perspective of the credit rating agencies, but conversely to the previous bullet point, whether the instrument is sufficiently debt-like to receive a solid credit rating from the rating agencies. From the perspective of investor eligibility, whether the instrument is eligible for investment by institutions that are restricted to debt securities and that cannot purchase equities. From the perspective of investor capital regulation, whether for risk-based capital regulation, such as for U.S. insurance companies, the capital charges applicable to an investment in the instrument are those of debt, which are generally quite low, or equity, which are generally much higher. And finally, from the perspective of index inclusion, whether the instrument may be included in broad-based debt indices. The ratings perspective for hybrids deserves closer scrutiny. Criteria have changed repeatedly as a result of continuing product innovation, evolving regulatory standards, and experiences acquired especially during the crisis. The first key question is the extent of equity credit that Moody's grants, or any other credit rating agency. Broadly speaking, each hybrid is classified in a basket from A to E on the Moody's debt equity continuum, with A closest to debt and E closest to equity. The second question is the amount of downward notching from the issuer's senior unsecured debt rating that is warranted by the instrument's equity characteristics. The recent discussion of so-called contingent capital under Basel III, which is either written down or converted into common shares upon a pre-specified trigger, has attracted much commentary and disagreement among the agencies. A separate module will discuss hybrids and contingent capital in far greater detail. But for now we have reached the end of this chapter 3, and this brings us to the quiz.